Good morning, everyone, and welcome to our DAT Weekly Market Update. This is our update for May 7th, 2024. I'm Ken Adamo, Chief of Analytics over here at DAT, joined by Dean Croak, who's our Principal Industry Analyst. Morning, Dean.
Hey, good morning. Good morning.
Fresh back from your trip to the heart of it all, the great state of Ohio.
Yeah, I had a great trip out there to see the folks at Ease Logistics yesterday. Very impressive operation in the heart of...
Was there any hubbub about the commencement speech at Ohio State over the weekend?
Oh, I didn't hear anything at all.
Oh, no. You should actually look into this. So they hired, well, actually, they don't pay for commencement speakers per policy, so they have like a board, but they selected a former student who wrote his speech with AI while tripping on ayahuasca. It included handing out bracelets, shirtless singing "You Are My Sunshine," I believe, or "This Little Light of Mine," and shilling for his Bitcoin company. Apparently, it's the only commencement speaker in Ohio State history to be booed by the entire student body.
I'm surprised. I'm shocked.
And then someone fell to their death from C deck. So it was not a great weekend to graduate as a Buckeye, I don't think.
True story? Someone fell from the deck?
Someone fell from C deck, yeah, during the commencement ceremony. Yeah, it's pretty tragic. So
that's terrible.
All in all, and keep in mind, these kids never got a graduation because they graduated in 2020 during COVID. So that's like I have several of my friends or parents who had kids, and they were appalled that after spending $100 and some thousand, that's what they had to sit through. Not like Colin Powell or Barack Obama or John Glenn did it years ago, famous Ohio State alumni. But anyway, so what else is going on? Some pretty crazy weather rolling our way, Dean. I don't know if you saw, Oklahoma can't stay out of it.
Yeah, I saw that. That's going to be pretty horrific this week, I suspect. I noticed this week, Ken, I was kind of surprised. My son's out in Lake Tahoe at the ski resort there. They were getting about 18 inches of snow, and I thought we'd done with winter. They closed down Interstate 80 over the Donner Pass over the weekend. So that's another major disruption.
Yeah, apparently, like the Mountain West can't get out of this slushy spring snow. A lot of them have it, like Montana and stuff hasn't had summer yet. I was listening to the Weather Channel in the background the other day. It's kind of crazy. But
it's the worst kind, the slushy stuff for truckers.
Yeah. I reached out to our friends at Werner. They had been hit hard a couple of weeks ago with the tornadoes, and luckily they were mostly safe and sound. A lot of them are camped out in Werner, the headquarters basement, as the storms.
Right.
It's just, if you've not been out there to the Great Plains area, there's just nowhere to hide. It's just terrifying.
Exactly. Yep.
Anyway, enough weather talk from two amateur meteorologists. I'm going to get us to the key points of the week. It's just Dean and us today, so we'll have a good discussion, I think, towards the end of the show about what's going on out there. So spot rates rise, end of month volumes create higher demand. We're in the precipice here of road check week. Starting to see some return to seasonality, which I think is a big, to all of us, right? A little sigh of relief that we're starting to see rates creep up a bit. Active contract rates flat, replacement rates 2% lower. That number getting closer or hovering around zeros. Good thing for us. The illustrious Jerome Powell, no cuts, but no increase either, thankfully. Class 8 truck orders down 10% month over month. Results as expected at the worst time of the year for orders, the bottom of on-highway tractor buyers' profitability cycles. So with that, turn over to Dean for the market update.
Maybe we can come back to the Fed interest rate discussion and talk about the impact of debt on corporations and consumers a little bit later on, Ken. All right, so let's start off the market update with a look at our load posts in the dry van sector. Load post volume is pretty high last week, highest in 6 weeks. So they're certainly on the rise, up 11% across the end of month. That's a normal monthly occurrence in more normal times to see an end of month push. Volumes are sitting about 6% higher than last year. Capacity decreased, load posts equipment posts dropped a little bit. Load to truck ratio down. Up slightly, actually, looking at the chart here, up to 3.81. In the refrigerated category, early season strength in the produce market, led mainly by California, where volumes are up about 18% year over year. That boosted truckload spot market volumes last week. They were up 12% week over week. Capacity dropped also, load to truck ratio up to 5.62. In the dry van sector, after decreasing for the last 5 weeks, again across the end of the month period last week, load posts up about 5%, sitting about 5% lower than this time last year. And load posts are sitting about 6% higher than 2019. Load to truck ratio up slightly to 18.12 last week. Having a look at a couple of our markets, let's start off with the top 5 markets nationally in the spot market. California, Texas, Illinois, Georgia, and New Jersey. Line haul rates up 2 cents a mile. They averaged $1.70 a mile across those 5 states last week. Some pretty good gains were reported in California for carriers. Loads moved were up about 1% last week, while line haul rates for outbound loads out of California up 5 cents to $1.90. That's about 4 cents a mile higher than this time last year. One of the benchmark lanes I look at that links very closely to the retail market and imports from Asia is the Los Angeles to Stockton market. It's a fairly big warehouse market. The number of loads moving on that lane jumped 15% week over week. Spot rates up 4 cents a mile to $2.58, sitting about 6 cents a mile lower than this time last year as a reference point. Some pretty good gains are also reported in Georgia. Rates up 5 cents a mile to $1.69 for outbound loads. Loads moved were up about 2% week over week. One of the big lanes that we watch out of the Atlanta, Georgia market is Lakeland, Florida. Loads moved were down 1% last week. Spot rates flat at $2.48. Produce season is having an impact on dry van carriers as some of the capacity shifts. Produce season, late May is typically when we see produce season peak in Florida, but it capacity tightens from last week all the way through to the end of the month. Dry van capacity tighter last week for outbound loads in Florida. Rates up 6 cents a mile to $1.16. But as a reference point, they're trailing 2019 and last year by 10 cents per mile. In the refrigerated market, produce is, of course, the main story. 54% of produce loads last week came out of California and Florida, according to the USDA. Good news is California truckload volume is up about 18% year over year, while Florida is down 6% year over year. Not enough traction to put national volumes up substantially, although California is starting to dominate the weekly truckload volumes. It's just flipped for the first time. Up until the last few weeks, it was Washington State had the biggest volume, but now we're back on track where California starts to dominate the market. It's a good sign heading into the produce season in May. Some pretty good volumes coming out of the Miami market last week. Of course, it is Mother's Day coming up shortly. A lot of volume is moving out of there, both for spring vegetables and floral shipments. There was a shortage of trucks last week for the first time reported by the USDA, mainly for spring vegetable loads to Baltimore, Boston, Philly, and New York. Northbound reefer capacity, it typically tightens all the way through to May 12 on Mother's Day. So we expect, and looking at rate casts, it looks like some of our rate forecasts peaked early this week, so maybe we've seen the peak there already. Outbound in Miami, loads moved were up 16% last week. There was a short-term capacity crunch over the weekend. Reefer rates up 25% to $2.18 a mile. On the top lane out of Miami, carriers were paid, that's to Atlanta, sorry, carriers were paid an average of $2.21. That's excluding fuel. That's also identical to the May average last year. Produce loads from Central Florida, where a lot of the vegetables are coming from, and early season fruit, Lakeland to New York, carriers were paid $2.83 last week. That's up 47 cents per mile week over week on a 23% higher volume of loads moved. On the Baltimore lane, capacity was also very tight. Lakeland to Baltimore rates averaged $2.69. It's almost $1 per mile higher than last month's average and about 8 cents a mile higher than last year's May average line haul rate. In the flatbed market, despite loads moving in Texas up 5% last week, capacity did ease slightly. Line haul rates dropped 2 cents a mile to $2.10. That's about 8 cents a mile higher than last year. 2019, and about 24 cents a mile lower than last year. In the largest spot market in the flatbed sector in Houston, loads moved outbound were flat. Spot rates down 3 cents a mile to $2.30. Having a look at some of the Gulf, the Great Lakes region, in the combined Gary, South Bend, Indiana markets, a lot of steel comes out of those markets. Capacity eased also last week. Loads moved were up 13% week over week, but rates dropped 4 cents to $2.37. They're sitting about 20 cents a mile lower than where they were last year for outbound Gary, South Bend in Cleveland. Nearby, line haul rates dropped a penny per mile, averaging about $2.57 for outbound loads on a 2% higher volume of loads moved. One of the big lanes out of Cleveland is Harrisburg. Loads moved were up 40% last week. Spot rates up almost a penny per mile to about, I think it was about 244 last time I looked on that lane. In the spot rates section of the report, year over year, a look at dry van. After drifting down slightly for the last 5 weeks, the national average dry van line haul rate increased by just over a penny per mile. No doubt end of month shipping volumes had something to do with that. The national average was $1.57, excluding fuel. It's about 5 cents a mile lower than last year on a 12% higher volume of loads moved. Produce season, Mother's Day floral shipments, pushing some meaningful volumes into the market. So no surprise that reefer line haul rates were up 4 cents a mile last week, sitting at about $1.89. Reefer line haul rates are 6 cents a mile lower on a 10% higher volume of loads moved compared to this time last year. And in flatbed, line haul rates up slightly through last week's end of month shipping period, sitting at about $2.03 per mile. That's 11 cents a mile lower than this time last year on a 20% higher volume of loads moved. So that's it for our market update this week. Remember, if you want to find out more about what's happening in freight, go to dat.com/market update. Our long form version of today's report will be published later this evening. So over you, Ken, for the short-term forecast.
Hey, Dean. So short terms this week, as we always do. The blue line is the historical 7-day weighted moving average. We start with dry van. These rates exclude fuel. And then we have 4 forecast models. We have a red, which is a short term, which is acting a fool, as the kids say this week. We have green, which is Ratecast, which is our flagship model in all of our products. And then we have an intermediate blend, 2 models, yellow and gray. They kind of blend in short and longer term effects. And I think let's just talk about this for a second. There's agreement that the market should be trending upwards over the next 35 days. I think there's just disagreement on around which degree to which it should go up. Again, I don't think the red's anything close to realistic. We show it just because you got to realize the market's oversold at this point. What that means is it's lower than the models would have predicted it to be. So they're sensing any movement upwards, which we've seen over the last week and a half, 7 to 10 days at least. And they want to extrapolate that out. And again, the red model will tend to overreact, and Ratecast will tend to blend in, again, what it knows historically, going back, I believe, 5 to 7 years. Let's go to refrigerated. Similar thing. You start to see the other side of that first push of produce season on these models happening towards the tail end of the 35-day forecast. But a similar effect across the model suite. You have red overreacting, green being the most tempered, and then the intermediate models straddling the difference largely between the two. Lastly, we'll have flatbed. And again, we end with some agreement. This is starting to put together a pretty nice linear trend. If you start at the beginning of this period, which is 2023, November of last year, and you strike a line through now, starting to see a pretty nice linear upward trend, especially if this forecast holds over the last, like I said, couple of quarters extending forward. That's a nice trend for flatbed for all of the reasons Dean talked about in the market update. So with that, I'm going to bring Dean back. We had our guest canceled on us this morning, which is fine. So it's going to be Dean and I yakking here for a few minutes, and then we might even end early today.
Yeah. Ken, I'm curious. Produce season generally is, we're starting to see some meaningful volumes. I mean, I noticed in Ratecast, it's looking at about a 10 cent per mile lift between now and kind of its peak. Normally, we'd see something in the order of 20 to 25 cents a mile lift over between now and July 4. That Ratecast forecast would suggest more like a 2019 type produce season impact on the spot market. Is that kind of how you read things also?
Yeah, I think that's right. I think if we put that question on a shelf for a minute, the thing that is most interesting to me in the current market is I went back and I trended that chart we show. It looks like a Christmas tree with red and green, the net motor carrier authorities. And I get it. Look, I've never proclaimed that is a great proxy for absolute capacity numbers. I know folks are quick to jump on that, but I do think it's really, really interesting that it's exhibited an almost perfectly linear trend for the 10 years plus. My guess is if we had data going back to deregulation, absent the Great Recession and the 2002 recession, that would probably look very similar, very
Mm.
similar linear upward trend.
Yeah.
And then all of a sudden you have this kind of crazy event. What's really interesting about that is we're still oversubscribed by about 15%, which means we have 15% more carry. If you would carry that linear line, which again had like 99% correlation on a linear trend, right? If you take that linear trend, which was growing at about 3% per year, and you take that and you carry it forward, we're still 15% over where that line would have been, even though we've attrited almost 40,000 carriers since the peak of COVID.
Yeah.
That's crazy.
Yeah. Yeah, and it's like we talked about last week, Ken. There's still a lot of carriers out there that, despite the grumblings and sort of the doom and gloom, a lot of carriers are actually doing quite okay. I think there's a bunch of carriers that are running fairly fine margins because of some higher operating costs, mainly because they entered too late in that last cycle to be viable longer term. But there's a lot of carriers out there that are quite flush with cash. A lot of them won't admit it, but when you talk to them, like I did in truck stops on Sunday while I was out in Ohio, there's I don't know how to quantify the number, but there seems to be more carriers than not that are doing quite well in this market with much lower operating costs. It's something that I've not seen before, and it's largely because of that massive amount of profit carriers made back in 2021. It's allowing them a much longer runway. How long that lasts, though, I'm not sure. And it kind of leads to Eduardo's question in the chat section here about fuel costs. And the question is, when are fuel costs going to go down? Eduardo, I don't think they will. For what it's worth, the EIA forecast has got rates pegged at about $4 a mile for the rest of the year. I think that's pretty much what we're expecting in terms of operating costs. As I look at the numbers here, fuel is representing about 34% or 61 cents a mile in terms of operating costs. If I was a carrier, that's what I'd be budgeting for the rest of the year, notwithstanding any massive, substantial geopolitical impact on the market. That looks like where we think fuel's going to sit for the rest of the year.
Yeah, I think so when we look at that, right, even if this data set is 25%, it explains 25% of the underlying capacity. That's still 10,000 power units probably over that long-term trend. So there's a couple things you can believe, right? There's either a secular shift that happened, which would line up perfectly. If you basically take where we sit now and say the trend's going to start from where we are today and go forward into history at that same linear clip from this point. What's interesting about that is you don't actually hit the COVID highs again until the end of 2028. So if you take the rate at which the market was growing pre-COVID, you adjust it up to where we kind of, if you assume that this is where it ends from a interstate motor carrier count, and you start that trend back up again and assume no pandemic or anything like that, we don't get back to the COVID highs until 2028, pushing 2029, which I think is crazy.
Yeah, it's so again, this is anecdotal, but when you do this often enough, you start to build a pretty good picture of where capacity is at relative to demand. There's a lot of carriers out there, and this is what gets missed in the numbers. I think there's a lot of carriers out there that this is a lifestyle, particularly in the independent contractor sector. For them, it's a lifestyle, and I don't want to downplay the role of operating costs, but for them, it's less about rate per mile and profit margins. It's more about funding a lifestyle, which is a lifestyle on the road. And while ever they can generate enough cash to fund that lifestyle, they're quite happy. And I know that doesn't make a lot of sense to a lot of people that will study numbers, but there's a lot of carriers out there that run in the spot market that are doing quite okay, because to them, low levels of debt means that they can get by. Now, they're not necessarily generating enough profit to trade up in their next trade cycle. That's why they tend to run older equipment that's very well maintained by themselves, and that's the difference. They can maintain their costs.
I think this is part of the problem, right? Like, we all fall victim to this, right? When your sports team's winning, it's all they're doing. It's masterful coaching and recruiting and all of this. And when they're losing, it's the referees or the schedule or not enough rest or injuries, right? Like, we all, whether we like to admit it or not, if we're true with ourselves, we love to move the goalposts. I think it's in human nature. So, like, when the market's going up, our publicly traded truckload companies, are their earnings indicative of the market condition at the time? It's like, well, No, right? Because they're massively levered into contract and all of this. And, where it's doom and gloom. And then there's 3 straight quarters of record breaking profits, right? And now, or I think it's just a lag. I think there was a study I saw on the internet yesterday, one of the social media sites, which I thought was pretty good, which was basically if you lag back 3 quarters, I think it was. I think I'm quoting that right. If you lag back most of the capacity indicators or spot indicators, whatever you want to call it, 3 quarters, then you're starting to get pretty well in line with kind of how current market conditions are forward projecting these like big, slow moving ships of corporate earnings. So in that regard, we've had a couple quarters of really bad publicly traded trucking company earnings. We probably have another quarter to go. That probably makes sense, right?
Yep.
I continue to hold this position that the highs we saw in COVID were much more shocking and unpredictable than the market we're seeing now. I made a post about this last week that basically said, if you only knew the 10 years predated the pandemic and you made some rather simple and kind of not scientific assumptions about increasing volatility, you may have not predicted when or how long we would have stayed, when we would have gotten to, or how long we would have stayed at this market bottom, but you would have predicted where the bottom would have happened within a penny.
Right.
But you would have never predicted June of 22. Never in 1.5 million years would you have predicted that to happen. Right. So it's like, I think we love also, it's human nature to obsess about what's happening now. And when it's bad right now, it's like, well, this is the worst it's ever been. It's kind of like how my kids think about dinner. It's like, this is the worst meal I've ever had. And then like 2 chicken nuggets later, it's the best meal they've ever had. Like they're just these victims of the absolute present. And I think sometimes as analysts, for as smart as we claim to be, that's a trap we all fall into.
Yeah. I mean, it's truck show season, right? So I go to the truck shows almost every other weekend, and the industry's doing just fine despite all the grumblings. A couple of good questions come in from our regular watchers, Matt Clark and John Pandole. I'm not sure how to answer John's question about currency rates. Ken, you're much better, I think, at maybe answering part of this question, but John's asking about the impact of produce exports from Mexico to the US impacted by a lower peso. He mentions 20% lower than 2 years ago. What I can tell you, John, on our produce dashboard this morning, you maybe have an answer to this in your question. Produce volumes from Mexico are down 21% year over year. That's surprising. I think you might recall a couple of weeks ago on the show, I mentioned that it looks like the Mexico produce season has already peaked, and it looks like it's peaked early. The big crops that you watch out of Mexico, tomatoes down 19% year over year, avocados down 32%, cucumbers down 23%. Why I mention those 3, they are the top 3 commodities in terms of truckload volumes across into the McAllen market. So produce volumes from Mexico are way down year over year, and it looks like that season has peaked a little bit lower than 22, 21, but a little bit higher than 2019. But Ken, if you can see the question there, do you have any thoughts on the impact of the peso on exports?
I don't think it will temper it all that much. I think Mexico has become, in the last year, has become the #1 trading partner of the United States. I think you have high ocean rates at the moment coming from a lot of the other countries that we might trade with. I don't know that they'll lose relative position. We might see a little bit of a slowdown or some choice, but all I can tell you about the peso is my in-laws go to Mexico for 2 weeks, twice a year, and they just were very, very disappointed in the current level of exchange rate. They were going a couple of years ago and getting 25 pesos to the dollar, and now they're getting 16 or 17. So that's about the limit of my knowledge there.
Right. A good question here. We've got a few more questions. Let's jump into them. Matt Clark, and this one's a good one for you, Ken. Matt Clark asks, he's been seeing some posts lately about freight broker margins. He doesn't think net margins have changed significantly. What do you think is driving the focus news on broker margins?
That I'm reporting it? I don't know that anyone else is. Basically, it's me reporting it, and then a bunch of crazy tinfoil hat carrier contingents out there saying I'm a shill for the brokerage industry. So I've got to imagine that most of that is derivative reporting on what I and a couple others have been doing. I also think like the major publicly traded brokerages like RXO, Uber, and Robinson have been talking about it a lot. And JB Hunt obviously had a disastrous earnings call. Right. The call was fine. I'm just saying the results were not good. where they talked a lot about margin compression. And the problem is you're seeing stable sequential margin. So I just published on Twitter my study of April, which is pretty much identical to February and March. But the problem is you're lapping really, really strong year-over-year comps, right? If you think about when the market's going, I don't know if this is going to work. When the market's going down and you have any stable base of fixed contracts, you're going to benefit greatly from that on a gross profit perspective. So what we're experiencing is the year-over-year fall, which is what most of these big publicly traded firms report on, is not good at all. But the sequential margins aren't bad. So that's what you're seeing. The problem, I think, totally wrapped up is you've got kind of cycle low margins. You've got cycle low revenue per shipment, which is tough, and lower number of shipments. So you basically have like a three-legged stool, right? You've got price, volume, and margin. All three of those. This is the hardest part of the cycle for a brokerage. All three of those are suffering because you've got lower volumes, lower revenue, and even look at fuel. Fuel generally is passed through, but it still counts as revenue, right? Like brokerages report the total collected from the shipper as their revenue. So I think when you look at like the transport topics list, there's a lot of ways to sensationalize. And I'm not saying they're lying, but there's a lot of ways to sensationalize what happened year over year. We're in a completely different energy regime. We're in a completely different rate regime. And there's less shipments moving around. Not a ton less, right, as Dean's been reporting, but fewer. Yep. So if you're losing 100 or 200 basis points in revenue, in price, and in margin, all total in a low margin business, that's not good. Much like what I hope happened to Georgia's football program, Matt Clark, between last season and this season. I hope they eroded all three legs of their stool heading into the 2024 college football season.
All right. Cody Kaler from ANZ Trucking in Arizona, I think Cody's based. Great question. Good call out. I should have mentioned that, Cody. Question is, how is California volume looking compared to 2019? The flooding last year in Salinas muted the start of the season. So it makes sense that this year is up compared to 2023. Great call out. I should have mentioned that. I just went back and looked, Cody, at 2019 volumes for the end of April. We are currently down 4% compared to 2019 as of 4:30. I also went back and looked at 2022. We're sitting almost the same as where we were in 2022 and probably about 5 or 6% lower than where we were in 2021. So my important takeaway there is we're catching up reasonably quickly. So maybe data in the next week or so might give us a better sense of where we're at. But good question, Cody. Thank you very much for that. So that's all the questions, Ken. We could wrap up.
We can wrap up. I think just a couple things, since we do have some time and it's just us. I think some things to really be paying attention to. A lot of folks are in the midst of their spring RFPs, especially brokers, right? And I think the number one question we get is, I know the market's going to recover from this point, right? If it's a bottom, theoretically speaking, practically speaking, not even theoretically, if it's a bottom, it's not going to go lower, right? What do you do when you're competing against unsophisticated competition, right? Competition I guess I'd say unsophisticated and potentially unethical or unscrupulous competition that says, hey, I'm just going to bid the current market rates. And when the rates go back up, I'll reject all of my offers and give it back to the shipper. Talking to Chris Jolly, talking to a couple other folks that I know and respect, I think a great technique is work with your shipper. One, try to educate them the best you can. David Spencer over at Arrive does a great job of this, amongst other firms. And if that's not really working, I think pushing towards a shorter bid length can usually benefit both parties. It's not a foreign concept. A lot of shippers shorten their bids during COVID. And I think it minimizes your exposure, right? So if you can compete head-to-head on a 3 or a 6 month bid, you de-risk a lot of what's going to happen in the back half of the next year, right? A lot of folks are talking about meaningful recovery not starting for at least a few quarters. But that on a 12-month contract, that could put you into some serious jeopardy 3 months from now. So all of that to summarize to say, look, you're in business for the long term, right? Don't mortgage your future now. as you're running these bids and as you're making decisions, because the last thing you want to do is not take advantage of the market when it starts to turn and be locked in at severely crippled revenue generating contracts. So that's something I think to really, really pay attention to right now. It's admittedly the scariest time in the freight cycle to price as a broker and as a carrier, to be quite honest, an asset-based carrier. So I'd keep your wits about you and try everything you can to price in what you believe the future is going to hold.
Okay.
Anything else to add on top of that, Dean?
No, it makes complete sense to me. I think that's the right strategy.
Cool. All right. Any plugs? Did we already do plugs? I can't remember.
No, we didn't. No, we can whip into those now. Logistics Live tomorrow with Dan Deegan. Robert Rouse, of course, is on Landline now, as always, Sirius XM. I'll be on with Jimmy Mack on Channel 146 Road Dog Radio on Thursday morning, 8 a.m., talking about the trucking industry. You can catch the Freightline podcast. Chris Kaplis is talking to Microsoft exec Mike Bassini about using AI. Next week's show, we've got Heather Dawn from Dawn Transfer on the show. She's a wonderful guest. Looking forward to having her on. Don't forget, Roadcheck Week is next week. And also, for those in the New Orleans area, the TSMA conference is on June 9 to 11 in downtown New Orleans. Back to you, Ken, to wrap up the show.
All right. So we have a team at Gardner right now. If you're there, if you're listening on your way into the conference, go say hello. We've got quite the presence there. From all the pictures, I just absolutely cannot in my mind justify or reconcile. I went to TIA. If I had have read the newspaper, the freight newspaper heading into TIA, I'd have thought there'd have been like 3 janitors and 10 attendees, right? But there's 1,600 people boozing it up, living it up, playing golf, trying to avoid the scorpions. The pictures I saw from Gartner yesterday, which admittedly is a more shipper-focused conference, and they've been playing a lot of golf in the last 2 years because they haven't had to really work hard to get good rates. I love you, shippers. I mean that with love. But go see us at Gartner. We've got our executive symposium coming up. We're looking forward to that. Already starting to look ahead to the Inland Conference with JOC in the fall. I know they're building an amazing roster for that, so we'll see folks there. And then also TIA Technovations takes place in the fall, and we'll be starting to advertise for DATCon. We've got early signups coming in. Yeah. We'll be in Kansas City. Great barbecue. It's outside of the tornado season. We'll be ready to rock and roll down there in Kansas City. So with that, we're going to sign off.
ACT Research Conference in Columbus, Indiana.
It's a seminar, Dean, not a conference.
It's a seminar, a biannual seminar.
I know. The home state of Michael Jackson and Larry Bird. So we'll be loading the bus up to head out there and see everyone there. But with that, have a safe week. We'll see you next Tuesday at 10 a.m. Eastern. Bye, everyone.
Okay. Bye.